Welcome back to the Share Planner YouTube channel. On this video, I'm going to talk to you about not chasing gaps higher at the open. This is one of the biggest mistakes that traders make, and it's such an avoidable loss, but yet they do it anyways. They get hyped up about a news piece that hits the wires in the pre-market or from the after hours the day before, and instead of just using a little bit of calm and letting price settle down, they just chase right after it at the market open, and then they just get scorched by the price fading the rest of the day. So really what I want to do is I want to highlight using today's news with Tesla. Tesla had a big news event that came out with the FSD. China gave them the approval to do that whole FSD, full self-driving in China. The stock's opening up like 13, 14%. But I want to show you just using Tesla and also some of the more recent examples about how that's a bad idea to go chasing after these gaps. Yes, you may get away with it once or twice, but eventually that kind of trading mentality of just chasing after these high flyers that have already made massive moves is going to come back to bite you. So you have the Tesla price action here. You had a huge gap up higher. It finished 15% up on the day. And that was the day prior. It was struggling to break through this declining resistance. You can see it's not breaking through it necessarily. And there really wasn't a reason to get long on it prior to the close on Friday. You get the massive gap up, and then people are like, oh, I wish I was in it. I'm just going to go ahead and buy it now. Yes, you get away with it by getting long at the open. But really, was it that good a price action? Now, if you look at it from like a 2-minute chart, for instance, and we tag, let's say, the anchored VWAP, and you're trying to play it off the anchor VWAP. You got a little bit of a sideways price action, then it gives you the rally, then it comes back down. And this was really the only place to play it off of the AVWAP at 190, almost 192. Let's say you get in at 192. It closes the day at 194. Was that really that good of a trade? Not really. I mean, it wasn't even a full 1% move. So all that risk trying to trade something that's up 15%, and you're only walking away with about 1% in gains. Now, one of the other things that I noticed that a lot of people do, they'll do the large gaps higher on these penny stocks or on these stocks that are like trading at $2 or $3. And those are even more dangerous because it can move like 10%. If it's up like 20%, it can still move like 10% to the downside and go shooting right back up. So that makes those even more dangerous. Now, take a look at Microsoft. This one had a significant gap higher. If you chased after it at the open on Friday, you got in probably around like 406.32. And then now you're looking at a stock that's trading at 402.25. It gave up a bunch of gains on Friday and had follow through today, and then it filled that gap. You would have been better off to wait for it to fill the gap and then to get higher. And that's one of the main takeaways here that I would say is that if you're really that interested, wait for it to fill the gap before trying to get long on it, because oftentimes you'll get that opportunity because gaps in the chart like this one right here, they come back and get filled. If you want to look at it from a little bit better of an angle, these gaps will get filled. So check this out. I mean, it was filled almost to perfection today and gave you two separate opportunities to be able to get long on it. You look at Google, blowout earnings, huge gap higher. Let's draw the gap right here. There's your gap, massive gap higher. And what does it do? Rest of the day, trade sideways, slightly lower. You can see didn't really do all that great intraday. And now it's in the gap as well. Look at that. Right there in the gap, it's struggling to hold those gains. So if you got in at the open, you got in probably around on Friday at 174-ish. Now it's trading at 166. You're down over 5% on the trade. So going back to Tesla then, you got the gap higher. We haven't started even filling the gap yet. There's a good chance, though, that that's going to get filled in the coming days. I don't see the FSD China news as being something that we're going to be saying 6 months from now. Oh, man, thank you that we got the FSD China news. Maybe we do. Maybe I'm wrong. But just my personal opinion, would not be surprised to see this thing fill the gap here at some time in the near future. Now, let's look at one more stock, and we'll wrap this up. Meta. This thing has gaps within gaps. This is an ugly chart. But let's look at it from a risk-reward management standpoint. How do you actually manage the risk on this? If you buy it at the open, So for instance, you get in Meta at 459.70. You put your stop loss, really the closest thing, because you don't want to risk a gap fill, do you? So you put your stop loss below 453.01. That was the lows of the day. That's where it hit. So you get in at 459.70. You put your stop loss below 453.01. And what happens? 2 days later, it strikes 453, and it's now back off to the races. Because there's not a logical place to put your stop loss at. In fact, oftentimes it will toy with trying to go down into that gap and trying to make you think that it's going to fill before it ultimately continues to push higher. Let's fast forward to just a couple of days ago on Meta. Here you have a significant gap lower. If you were trying to short right at the open because you saw the gap down, you're like, this is something that I need to jump in on and get in on this price action, because that's what's really driving a lot of motivations when they see these charts is the desire to get in on the action, that it's going to leave the train station and you're not going to be on that train. So if you get in at 420.50, it closes the day at 441 because all it did is spend the rest of the time rallying off of the lows. Yes, it's still way down, but also notice here too how it sneaks just a few pennies into the gap before it resumes to push lower. So in wrapping up, there's really not an effective way of managing the risk that you can keep the risk tight while letting the winners run wild when it comes to these huge gaps higher. Some people will disagree with me on that, but I've seen enough gaps to where I know that it's very, very difficult, especially the lower in price you go, it gets you far worse. And it's oftentimes a lazy approach or tactic that retail will take in their trading. People will look at the gaps higher and the gaps lower at the open, and they'll start making their trading decisions of what stocks that they're going to get in them based off of which stocks are seeing the most volume and the biggest gaps at the open. So you really want to try to avoid jumping into these stocks just because they're gapping higher, because there's a lot of talk about it, just because it's trending on Twitter or on StockTwits, because those are the ones that will get you in the biggest mess. If you enjoyed this video, I'd encourage you to like and subscribe, and let me know down in the comments, what is your approach when it comes to gaps? What if you're in the stock and it's already gapping up? Do you start to take some profits, or do you actually have a trading strategy that you use that pertains to gaps that might interest us all? Let us know down in the comments. Thank you guys, and God bless.